Hello, I'm James Sheard from the Accountancy People, and today I want to talk about the different wrappers you can put your savings and investments in that are government approved. There are a number of different wrappers you can put around your investments, and they can save you a whole load of tax. And as we go through into the 2017-18 tax year, both we get a new allowance for the year and there are some new wrappers available. So I want to talk about both of those. The first one I want to talk about is the LISA, Lifetime Savings Account, or LISA. This is a new thing from April 2017. And what it means is that if you are under 40, so you've got to be under 40 to take advantage of it, and you can save up to £400 a month, and the government tops that up to £500 a month. So you're basically getting 25% extra on your money. Of course, there's always a but when there's a government wrapper, and the but is that you can only use it for two purposes. You can use it for your first house, or you can take it out tax-free when you're 60. So obviously you can only have a LISA if you're under 40, so therefore you've got at least 20 years to wait until you can get the money out, unless of course you don't have a house at the moment, in which case you can save up for your first deposit. So there's two ways in which you can use it. I think it's a really good way for grandparents and parents to save for their adult children, because very often they're expected or want to help them with a deposit for their first house, so it's a really good way of doing that. And then of course, if you are under 40 and you still haven't got your first house, then it's a great way of getting money for your deposit for your first house. However, of course, if you are under 40 and you already have a house, you'll only ever be able to use the money when you're 60, or of course the tax benefit goes away. So that's the LISA. So shall I now move on to the normal ISA? So there is an important change to normal ISAs in that the limit that you can put in every year is increased to £20,000. So that's £20,000 for each part of a couple. So as a couple you can put in £40,000, which is a substantial amount of money. The great thing about ISAs is that once the money's in that wrapper, it's free from capital gains tax, so any gains that you make, and it's also free from high rate tax, and it's free from the new dividend tax. So there's quite a lot of tax savings available within that. I think it really comes into its own with equity ISAs, because with equity ISAs you potentially have capital gains, whereas with cash ISAs you don't have any capital gains, and in truth the returns on cash, any sort of cash on interest, is so small as the tax saving isn't very significant. Moving on now to pensions. Pensions remain a great way of avoiding tax. They have inheritance tax benefits because money in a pension scheme is out with your inheritance tax estate. As you put the money in, you don't pay income tax. So if you're a 40% taxpayer or 46% taxpayer, then you don't pay that tax and the money goes in gross. And then the money accumulates within the pension scheme free of income taxes and free of capital gains tax. So that's a good package of savings. And then on the way out, you will be taxed as income when you take the money out, except for the 25% tax-free lump sum. There are of course some restrictions on that. The main restrictions being you can only put £40,000 a year in. So now we're in a new tax year, you can put another £40,000, so that's helpful. And there is an overall limit, which at the moment is £1 million. So you can only have £1 million in your pension scheme, although historically there are some older limits that are still available if you've had a pension for a long time. So I guess the next thing that's worth considering is whether you should use a lifetime ISA, or a normal ISA, or a pension scheme. Well, I think that there is a benefit in using all of them. If you're a high rate taxpayer, pensions are particularly good because you get the high rate tax relief as you put the money in, and I'm not convinced that will be available forever. So I think that's a great benefit. I think if you don't have a house and you're under 40, I think you should definitely think about using your lifetime ISA allowance. And if you do have share portfolios, then I think making sure that you use your ISA allowance and building that up over the years is a really important way of structurally making sure that you don't pay too much tax. Of course, there are also some more exotic things that you can use, like for example the EIS scheme or CDIS schemes, and the way that they work is that if you've made gains, then you can not pay capital gains tax and defer them onto these onto EIS and CDIS investments, which can be really good if you've made substantial gains. And they also can be an income tax reducer, so you reduce your income tax by 30 or 50% of the amount that you invest in these things. Well, that sounds fantastic. So what's the catch? The catch, of course, is that EIS and CDIS is for very risky enterprises that are often not profitable, and that are more conceptual than actual properly functioning businesses. So therefore the risk is very high. So although you get all this tax saving, there's a high possibility that you'll lose the money. So you pays your money, you takes your chance. So I hope that's useful. I'll certainly be making use of my pensions and ISA allowances, and I'd suggest that you do too. This is James Sheard from the Accountancy People. If you've got any questions about anything I've discussed, please get in touch.